Welcome to The Explainer. Today, we are diving into a financial tool that is honestly a total game changer. We're talking about the Ohio 529 tax deduction, a brilliant way to lower your state taxes today while building generational wealth for tomorrow. If you want a structured, practical way to maximize your tax benefits, you are absolutely in the right place.
Let me ask you something. Are you leaving thousands of dollars on the table at tax time? Taxes take a massive bite out of our paychecks every single year, right? But the Ohio 529 deduction acts as this incredible dual-purpose tool. It essentially allows you to legitimately lower your taxable income right now, all while setting aside tax-advantaged money to pay for education later. If you aren't using this, you might literally be tossing money away.
So, here is our tactical playbook for today. We'll quickly cover 1. Ohio 529 basics. 2. Tax parity and eligibility. 3. The numbers and limits. 4. A step-by-step claiming guide. 5. Traps to avoid. And finally, 6. Long-term strategy. Let's jump right into Section 1, Ohio 529 Basics. Okay, so it's really easy to get these tax benefits mixed up. On the federal level, 529 plans give you tax-deferred growth, and the withdrawals are completely tax-free if you use them for qualified education expenses. But there is no federal deduction for just putting the money in. The state level, however, specifically in Ohio, is where the magic happens. You get an upfront income tax deduction. You literally get a tax break on your current year's state income just for making the contribution. Moving right along to Section 2, Tax Parity and Eligibility. There was a massive legislative change recently called tax parity. For the longest time, you could only snag that Ohio tax deduction if you contributed to Ohio's specific plan, the College Advantage 529. But starting back in the 2023 tax year, Ohio adopted tax parity. What does that mean for you? It means you can now claim the state income tax deduction for contributions made to absolutely any state-sponsored 529 plan across the entire country. You're no longer boxed into just one single plan to get your tax break. And who exactly gets to claim it? Well, this is where it gets really fun. The deduction goes to the person who actually makes the contribution. You don't even have to be the account owner. As long as you file Ohio taxes, you can be a parent, a grandparent, an aunt, an uncle, or just a really good friend. If you write the check, you get the deduction on your own state tax return.
All right, Section 3, the numbers and limits.
Pay close attention to this number, $4,000. That is the annual Ohio tax deduction limit per beneficiary per year, and it doesn't even matter what your filing status is. If you're at Ohio's top marginal tax rate, that $4,000 deduction translates to over $150 of cold, hard cash kept right in your pocket, per beneficiary, every single year. But hold on, because it actually gets better. This next rule perfectly illustrates the true power of the Ohio plan, the unlimited carry-forward rule. Let's say you drop a giant $20,000 lump sum into a 529 account today. Well, you can deduct $4,000 on this year's taxes and then literally carry forward the remaining $16,000. You can just keep deducting $4,000 every single future tax year until that entire $20,000 has been written off. It never expires. Now, if you're wondering how much you can put in at once without triggering any federal gift taxes, that magic number is currently $19,000 per individual contributor or $38,000 for a married couple. So, high-income earners can rapidly front-load these accounts, stay completely under the gift tax exclusion, and secure multi-year state tax deductions thanks to that awesome carry-forward rule. And just to show you that this is a serious, heavyweight wealth-building vehicle, the maximum account balance limit per beneficiary for the Ohio plan is a staggering $517,000. You can literally keep contributing and carrying forward those deductions until the account hits that massive ceiling.
Let's pivot to Section 4, Step-by-Step Claiming Guide.
How do you actually execute this when tax time rolls around? It boils down to 3 simple steps. First, gather your documents. You'll need the year-end 529 statement plus your bank records proving you made the payment. Second, fill out the Ohio Schedule of Adjustments. Don't go looking for this deduction on the main IT-1040 form right off the bat. It lives on the Schedule of Adjustments, which then feeds into your final IT-1040 return for Step 3. When you're looking at your actual tax documents, you are going to want to flip over to page 2 of the Ohio Schedule of Adjustments. Scroll down to the Education section right there on line 31 where it says Amounts Contributed to Ohio College Advantage. That is exactly where you punch in your deductible contribution. Or, if you use tax software, just search for the 529 Education Deduction Information screen in the State section, and it'll autofill that line for you.
All right, Section 5, Traps to Avoid. We definitely need to make sure you don't accidentally trigger a state tax audit or painful penalties. The biggest trap by far is non-qualified expense recapture. Basically, if you pull money out of the 529 and spend it on something that isn't education, like, say, buying a sports car, you are gonna get hit hard. First, you face a 10% federal penalty on the earnings. Second, those earnings are taxed as ordinary income. But here is the real Ohio-specific kicker. Any previous state deductions you claimed for those contributions, those have to be added back to your Ohio income. You literally have to report it on line 4 of your schedule of adjustments, which immediately spikes your tax bill for that year.
Here's another trap that catches people off guard: your documentation. The Ohio Department of Taxation conducts regular compliance reviews, and honestly, they will not just take your word for it. A 529 year-end statement all by itself is not enough proof for an audit. The taxman wants to see the literal receipts. We're talking canceled checks, bank statements, or credit card statements that definitively show the money left your account. Always, always keep those records. Finally, Section 6, Long-Term Strategy. Let's connect these tactical moves to your long-term legacy. Think about these 2 core strategies. First up is bunching. Think of it like front-loading a massive sale. Imagine an aunt gets a huge bonus at work. She can bunch a massive lump sum contribution into her nephew's 529 today, invest that money immediately so it gets tax-free growth, and then use that unlimited carry-forward rule we talked about to keep claiming a $4,000 deduction for years. The second strategy is stacking. Remember, the deduction limit is per beneficiary. So if a grandparent opens accounts for 3 different grandchildren and puts $4,000 into each one, they just stacked their state tax deduction to $12,000 in a single year.
And please don't worry about the money somehow getting trapped if the kid decides a traditional 4-year college isn't for them. Qualified expenses are incredibly flexible. Yes, it obviously covers universities and community colleges, but it also covers K-12 private tuition up to $10,000 a year. It covers trade schools, vocational schools, and even costs associated with registered apprenticeship programs. The money adapts to whatever path they choose. Now, before we completely wrap up, I do need to give a quick professional disclaimer. This explainer is strictly for educational purposes, and as we all know, tax laws are always subject to change. Please definitely consult with a qualified CPA, tax advisor, or financial planner to get personalized advice tailored to your exact situation. So I want to leave you with this final provocative thought. What will your educational legacy be? And exactly how much money can you save while building it? The Ohio 529 deduction is this phenomenal wealth-building tool sitting right there waiting for you. It empowers you to support the next generation while keeping more of your hard-earned money right now. Put this information to work and start maximizing those benefits. Thanks so much for joining me on The Explainer today.